Aku, Natania Imanina Matram. Sebagian orang mungkin menganggap aku hanya orang yang beruntung. Tapi percayalah, aku pun perlu berjuang dengan hebat. Sebuah kebanggaan bagiku dapat meneruskan sejarah kecil keluargaku dengan lulus dari salah satu universitas terbaik di Indonesia seperti keluargaku lainnya. Dan tentunya, terima kasih kepada Bapak dan Mama yang selalu menjadi penyemangat dan pendukung nomor satuku. Aku sadar betul bahwa menghadapi dunia ini perlu persiapan yang luar biasa. Jadi, aku hanya berniat membagi apa yang kupunya, karena aku yakin pendidikan apapun bentuknya bisa membuka berbagai jendela kesempatan untuk mereka. Tahun 2018 yang lalu, aku bersama kakakku, Nasya Matram, menjalankan Rumah Belajar Mawar. Rumah belajar ini gratis untuk anak-anak yang kurang mampu. Materi yang diajarkan adalah matematika dan bahasa Inggris untuk murid sekolah dasar. Anak-anak belajar dari pagi hingga sore hari, tiap akhir pekan, didampingi oleh relawan pengajar. Tapi sayangnya, kegiatan belajar bersama ini harus diberhentikan sementara, menunggu situasi kembali kondusif. Percayalah, aku hanya mencoba untuk bersyukur atas apa yang kupunya. Siapa tahu, kelak dunia bisa menjadi lebih baik di tangan mereka, bukan? Karena kita yakin, pada setiap pengorbanan, selalu ada kebahagiaan yang tak tergantikan.
Dunia ini semakin maju, dunia bisnis juga terus mengalami perkembangan dan persaingan yang ketat. Sudah siapkah Anda menghadapinya? Faktanya, di dunia bisnis, nilai sebuah perusahaan tidak hanya dipandang dari profit dan loss-nya saja. Hal yang sebenarnya yang paling penting adalah perusahaan dapat mengetahui seberapa besar value dari bisnisnya. Ini akan menentukan pertumbuhan dan keberlanjutan bisnisnya di masa depan, sehingga dapat memudahkan suatu bisnis atau perusahaan mendapatkan sebuah kepercayaan dari para investor. Memahami bisnis valuation juga hal yang sangat penting bagi seorang akuntan dan akuntan publik. Karena akuntan dan akuntan publik memiliki peran yang penting dalam membuat laporan keuangan dan memahami value dari sebuah bisnis. Memahami bisnis valuation juga merupakan nilai tambah seorang akuntan dan akuntan publik. Jika kamu ingin memahami bisnis valuation, kamu harus mengikuti program yang satu ini. Namanya CVV. Jadi tunggu apa lagi? Persiapkan skillmu dari sekarang. Jangan sampai kamu tertinggal dengan yang lain. Jadilah trusted professional.
Sebagai upaya IAPI dalam meningkatkan pelayanan serta kompetensi para anggota dan umum, IAPI meluncurkan platform pembelajaran berbasis website yaitu Learning Management System atau LMS. LMS IAPI dapat memudahkan anggota IAPI maupun kalangan umum untuk mengakses berbagai pelatihan menarik dari IAPI yang dapat diakses di mana saja dan kapan saja. Bagi Anda yang merupakan anggota IAPI, dapat login pada halaman lms.iapi.or.id dengan akun anggota yang telah terdaftar. Dan bagi Anda peserta umum, registrasi akun dapat dilakukan cukup dengan mengisi informasi pendaftaran berikut. Kode OTP akan dikirimkan melalui email yang didaftarkan setelah peserta mengklik daftar. Pastikan Anda mengisi kolom OTP sesuai dengan kode yang dikirimkan. Namun bila terjadi kesalahan pengisian, kode OTP dapat dikirim ulang. Cek juga secara berkala kode OTP di folder spam jika OTP tidak masuk pada inbox. Setelah berhasil login ke LMS IAPI, Anda dapat melihat dan memilih pelatihan yang ingin diikuti. Baik mahasiswa, fresh graduate maupun peserta umum yang ingin meningkatkan skill, IAPI juga memiliki program CPA Indonesia Academy yang dapat menunjang pemahaman dan kompetensi baik di bidang audit, akuntansi, maupun perpajakan dengan investasi yang pastinya terjangkau. Selain itu, IAPI juga memiliki program pelatihan reguler ber-SKP bagi anggota IAPI yang ingin mengupgrade kompetensi serta sebagai pemenuhan kewajiban SKP. Program pelatihan ini tentu juga dapat diikuti oleh peserta umum yang ingin meningkatkan kompetensinya di bidang akuntansi, audit, pajak, dan topik-topik menarik lainnya yang relevan. Setelah memilih program pelatihan yang diinginkan, Anda akan diarahkan ke halaman pembayaran melalui payment gateway yang tentunya mudah dan aman. Anda juga dapat melihat status pelatihan yang diikuti dan juga mendownload e-sertifikat untuk beragam keperluan setelah menyelesaikan pelatihan. Bagaimana? Mudah bukan? Tunggu apa lagi? Segera kunjungi LMS IAPI dan nikmati program pelatihan menarik dari IAPI. Mau meningkatkan karir, kompetensi di bidang perpajakan, atau sedang mencari pekerjaan yang sesuai keinginan? Sekarang nggak perlu bingung lagi, karena semuanya bisa kamu dapatkan di brevet pajak A dan B IAPI. Kenapa sih kamu harus pilih brevet pajak IAPI? Berikut alasannya. Brevet pajak IAPI disupport oleh para praktisi perpajakan, dan akuntan publik yang sangat berpengalaman. Kelasnya online via Zoom bisa diakses dari mana saja, materi yang dibagikan up to date, dan sertifikatnya juga diterbitkan oleh IAPI. Brevet pajak IAPI dapat diikuti oleh berbagai kalangan loh, mulai dari mahasiswa, akuntan profesional, akuntan publik, dan umum. Banyak banget manfaat yang bisa kamu dapatkan, seperti meningkatkan karir, meningkatkan kompetensi dalam memperkuat jasa perpajakan, mempersiapkan diri dalam menghadapi ujian sertifikasi profesi CPA, USKP, dan lain-lain. Mempersiapkan akuntan publik yang akan bekerja sama dengan DJP. Meningkatkan kompetensi peserta dalam bidang perpajakan. Jadi, tunggu apa lagi? Segera daftar brevet pajak A dan B IAPI sekarang juga.
Aku, Natania Imanina Matram. Sebagian orang mungkin menganggap aku hanya orang yang beruntung. Tapi percayalah, aku pun perlu berjuang dengan hebat. Sebuah kebanggaan bagiku dapat meneruskan sejarah
participant, ladies and gentlemen, good morning. brings a wealth of experience in business development, customer service, and sales, including marketing, in a number of sectors. She has her accounting bachelor degree from University Erlangga and began her career at KPMG. She has lived and worked in both Indonesia and the US, where she has lived for over 10 years. When she attained her double degree in MBA and MSc and got some years of working experience in education recruitment at US institution. As head of ICCA Indonesia, she is also the chief representative to ICCA Representative Office in Indonesia on compliance matters. She enjoys cooking, playing with the children, including traveling. Okay, I kindly invite you, Ibu Hani Karunia, to guide this program. Bu Hani, it's your time.
Okay, thank you, Mbak Asri. Can you hear my voice? Okay.
I can hear I hear your voice, Bu Hani. Your voice is clear.
Okay, thank you. Good morning. Assalamualaikum warahmatullahi wabarakatuh. Welcome to our fourth event of our co-branding CERTBV webinar that is collaborated between ACCA and IAPI with the topic of how to increase your business valuation with a case study. My name is Hani Karunia and I'm the country manager of ACCA, Association of Chartered Certified Accountants in Indonesia. And I will be serving as your moderator today. You'll be hearing a presentation from Mr. Michael Masterson and Mr. Ivan Kanel today on this very timely topic. But before we get started, I want to take a few minutes of your time for me to read their CV or bios. Okay. Yeah, team, to share their bios on the screen, please. Thank you. Yeah, Mr. Michael Masterson is the Managing Director of Average. Michael now is based in Australia, a global intangible asset advisory, valuation, and corporate finance specialist. Michael has helped companies and investors to unlock their competitive edge by identifying, strategizing, valuing, and monetizing their intangible assets. Prior to joining Average, Michael was the Managing Director of Asia and New Zealand at Salesforce, now Salmart, driving the company to grow from 6 to 7,500 people in just over 8 years. Michael successfully led the business to become one of Omnicom Group's. It's listed in NYSE with the code OMC. Both successful and profitable acquisitions. Michael has turned around 2 mid-sized companies in the logistics and FMCG sectors. He is on several boards, including Cure Brain Cancer, named by the AFR as the most innovative charity and 25th most innovative organization. Yeah, next, I'm going to read the bio or CV of Mr. Ivan Kanel, whom also I had the pleasure of working when I just started my career in KPMG. Mr. Ivan Kanel, his master degrees is counting from the University of Tarumanegara, Jakarta, including his bachelor degree, and then also he has a master degree in finance. In his experience, currently Ivan is one of the managing partners for the KAP Kanel and Partner, and he also served as one of the tax committee board for the IAPI or Indonesian Institute of Certified Public Accountants. As you can see, all of his CV is very current. As of now, he's also part of the audit committee on several companies such as Devindo Realty Persada, and also he is part of the IAI compartment as a management member of the quality department, and including as a partner for the Zanshira Assign Alliance, the commissioner for Mahakarya, Cipta Sentosa, and founders for other companies as Analis Advis and Asia Global Investasi, and also Indonesia Global Law Firm. He's also a registered tax consultant and Asian. Okay, Michael, the time is yours. Thank you.
Thank you very much. And thank you for the opportunity to share my thoughts on how you increase a topic that's very dear to my heart, how you increase the value of a business using intangible assets.
Michael, a little bit. I think your voice is a bit muffled again now. Maybe it's just the position of the mic sometimes.
Is that any better? Testing 1, 2.
Yeah, it's a bit better. So
Okay, it might take a little while, but sometimes they automate. But is that clear now?
Yeah, it's better now. Okay, yeah, go ahead. Thank you so much.
Easy. If it goes wobbly again, though, please let me know. So what I want to do is briefly take you through our experience. And in terms of, I'm going to give you a quick overview on who Everidge is. We're very active in the Asia region. And I want to define intangible assets as we see them. And this is where we see most conversations. We find people go in different directions because they're talking about two completely different things. Third is how you can use intangible assets to actually increase valuation. But the last part I want to cover off is unfortunately how they can impact and decrease valuation. So there's two sides of the coin. Quick bit of background about us. We've been going for over 14 years. In fact, we've been talking about intangibles for a very long time. And we've worked with well over 2,000 clients. Offices throughout the world. In fact, we have a number of Indonesian clients, Singaporean clients. We've been in partnership with IAPI-ACCA now, I think, for 4 years as their global partner on intangible assets. And in particular, we did that because with IAPI-ACCA, they identified that one of the 10 disruptors to accounting is intangible assets. So where we get involved is these 5 key areas. First of all, you've got to identify what intangible assets the company actually has. And this is really key to getting the right valuation. Second of all is assessing the risks of the intangible assets. Third is coming up with a strategy to build value so that between point A and the future point that you can actually increase the value of the company. Then at that point, we get really involved with our clients in actually defining what that number is. And the number is critical, but the explanation is even more critical. And the last part is helping our clients out-license and sometimes sell their assets as well. So some of the people that we work with, unfortunately, these are just the ones that you might know. Most of our clients you've never heard of. But certainly in Singapore, we work with Singtel, Singpost, SATs, who I'm sure you've all experienced, and a number of the banking sector. And then for the US, people like Comcast, etc. So we've got a pretty incredible client list. So enough about us, let's get into intangible assets. The first slide I want to show you, this is the broadest economic measure of value that we can find. This is the S&P 500. Why do we use the S&P 500? Because it's been one of the fastest changing. Now, okay, this is a Western example, but we certainly see this in developing economies throughout Asia as well, following the similar trend. 1975, intangibles really didn't matter. It was essentially goodwill. The way you calculate this number is you take the market cap less the fixed assets, less the debt and the cash. The only thing that you've got left is essentially intangible assets. Two things you see happen in the 80s and 90s. The one that's really obvious is the technology companies coming on stream. People like Amazon, Facebook, Instagram. But you also saw US companies offshoring their balance sheets. In other words, freeing up the balance sheet, moving the plant, equipment, and machinery offshore. But they didn't just send over the what; they also sent over the how. And so now you see intangible assets account for 90% of the value of the S&P 500. That area of blue is our domain experience. We don't really focus on the yellow. We ignore the plant, the equipment, the machinery, but we certainly focus on differential, as mentioned. So intangible assets are now the biggest asset class in the world. Now, I mentioned before that the definition of intangible assets is really critical. So depending on who I'm talking to, they will have a frame of reference. More often than not, we find accountants talk about goodwill. When they're talking about intangible assets, I'm not talking about The current accounting definition of intangible assets, essentially, you acquire an asset, you bring it onto the balance sheet, you depreciate it for tax reasons. I'm taking the literal interpretation of intangible assets. It's intangible, e.g. it's non-physical. You can't kick it with your toe. And it's an asset. Now, the other mistake we often find is that people say, well, this isn't an asset to me, but it could be an asset to someone else. And we see this happen a lot, where companies inadvertently, or governments, give away assets without actually appreciating the value of the receiver. And you've heard all the other expressions. Warren Buffett, of course, calls it an economic moat. Lawyers often call it IP. But ultimately, this is how you're driving margin and/or market share. And intangible assets, these are the main 12 buckets of intangible assets that we see. So if you think about it, intangible assets don't operate in isolation of each other. They're a little bit like fingers. And as we know, fingers individually are very weak. You need to form them into fists to be strong. So if you think about, you're not going to pay 300, let's say US dollars for a pair of Nike shoes unless you can tell they're Nikes. But Nike couldn't run their business without their systems, their processes, their networks, their relationships, the data that they glean off what's going on in their sales channels and their markets. But also their relationships with people like Michael Jordan and many others gave them a massive increase in value. I said, what I'm not going to give you is the intangible assets. The regulatory approval will run that steel mill. The software that gets the steel mill to actually operate, customer information, who you sell to, the supplier information where you order from. This asset is now a liability. You can't operate a steel mill without intangible assets, as the most extreme example. So what we see going on is essentially this in pretty much every company or organisation we deal with, including we work with a number of government agencies. In that these assets are already there, but we're looking in the wrong place. And unfortunately, as we're all well aware, the accounting standards are quite responsible for this because the accounting standards were designed for an industrial age. And as that first graph shows, we are very far from being an industrial economy. So what you're finding is that what the accounts are telling you and what the value of the business is doing are becoming completely separated. And the more intangible they are, the more separated they often are. So let me give you an example of where maybe the balance sheet is not the answer we think it is. So this is Nortel. Nortel were the grey phone that everyone had on their desks in the 80s and 90s. And if you're wondering what happened to Nortel, they went into bankruptcy in 2009. Of course, the liquidator sold off the tangibles, essentially, for $3.2 billion. Now, what was interesting is that Nortel had about 6,000 patents. Now, they'd been brought onto the balance sheet at cost of $31 million. But the market was already saying, hey, these things are worth $1 billion. So we've got this massive disconnect with what the balance sheet is telling us and what reality is telling us. Now, here's where it gets interesting. They ended up selling for $4.5 billion, 145 times what they'd been recorded on the balance sheet. And they were worth more than the entire company. This is a really good example of where balance sheets are not where the answers are. And I probably don't need to convince anyone on this call of that. Now, what would we have done in hindsight? Well, if we could go back in time, we would have sold off the patents, put $4.5 billion into the company's bank account, use that to then go and buy Cisco, and now you would see Cisco on everyone's desk, you would almost certainly still see Nortel. So, okay, if the balance sheet's not where the answer is, how about the other document that we often have, the P&L? This is from a very dear friend of ours, Professor Brooke Lev, who, if you haven't read his book, The End of Accounting, is a must-read. Brooke is regarded as one of the thought leaders on accounting, and he's a professor at New York University. And he talks about how two companies achieve the same outcome of product X. Company A, of course, goes down the traditional path. They spend $10 million over a period of time on R&D so that you can make product X. Now, company B goes and acquires the assets so that it can achieve the same outcome. Now, what's interesting is that, of course, company A shows an expense in your P&L which pulls your earnings down, whereas company B, of course, shows as an asset on the balance sheet, which, of course, brings the value of the business up. But as we all know, from an investment point of view, it looks like company A is underperforming the B, but of course it's not.
Hello, Michael.
Honey.
Yeah, hello, Michael. Your voice is not clear. Maybe some trouble at your mic or some internet, your internet, or your.
Okay, how's that?
Your
Is there
voice
anything
is
down?
not clear because your voice is not.
Now I think it's a better now when you were just saying just now. Could you?
Okay, that's better.
Yeah, right. Yeah,
Okay.
yeah,
All right, I'll just change microphones.
yeah.
So, yeah, please let me know if that's fine. Okay, so as an example, so what you find is that the accounting treatment of intangible assets, again, as we all know, is essentially mostly identified in company reporting. And what company reporting, of course, then influences is the capital flows around that company. It also has to suit the regulatory framework and, of course, how you manage these assets. But most importantly, it affects how management behaves. So again, if again, I come from a CEO's background, if I look at my balance sheet, my P&L, and maybe I'm looking at my fixed asset register, as we all know, that's not where the value is in my business. And so unfortunately what you find is that for CEOs like myself, first of all, we don't understand the intangible assets we own. And in those 2,000 engagements, only one client was able to give us a reasonable list of what their intangible assets were. Which then means that if you don't know what you own, then you don't know what the risks are around those assets. So I'm going to come back to this. Third is, how's that driving my financial performance? In other words, what's actually generating that margin and or market share? And more importantly is, how can I use this to make more money? So let's jump into how you make money. How do we use this to increase value? And I'm going to give you some case studies. So this is probably the most important slide that we show, because most people just look at, so they have a good business, a bad business, a good idea, a bad idea. What they're not looking at is, do they have a strong or a weak intangible asset position? Now, this is critical, because if you've got a bad idea, well, who cares? It doesn't matter, because no one's going to copy you. The problem we have, though, is that if you've got a weak intangible asset position but a great idea, everyone copies you, and it's a race to the bottom of price. The best example I can give you of this is Grab, Gojek in Indonesia and Singapore, and of course, Lyft and Uber in the US. It's all about price. That's because they don't have strong intangible asset positions. Now, if you've got a strong intangible asset position, not only are you really hard to copy, in fact, you want to be as hard to copy as possible, but it means that you can create sustainable margins over time. So if we just take the right-hand side, what this means is that the strength of your intangible assets is a proxy for your market share. Indeed, if you've got a perfect intangible asset position, you will have 100% market share. And of course, market share is a proxy for your revenue and your margins, which is how you derive your profit, and ultimately how you give your investors a return. In other words, the strength of your intangible assets is directly linked to ROI. Let me give you some case studies. So this was a client that we got really to at the very end of the process. They were looking for an exit. It was a professional services business. They'd been going for 30 years, and their investment bank that they were using told them they were worth 4 times EBITDA. Now, 4 times earnings in this case was actually quite generous, because many services businesses are going for 1 or maybe 2 times. When we had a look through the business, we identified one of their critical assets is that they built up a data set over the last 30 years. Now, not all data is valuable, but in this case, it was valuable because we identified who the likely buyers would be of the data. Now, what was interesting is the investment bank kind of ignored this thesis because they saw it as being a trade buyer. And of course, a trade buyer would either have the same or better data. But by identifying those 4 other industries that would want the data because it could be used for actuarial purposes, we ended up selling that business for 32 times EBITDA. This is a direct example of where we get an 8-fold increase through identifying the right asset and identifying the right buyer for that asset. This next one was a large listed company in Australasia. They couldn't grow anymore in their home market. They identified you as partner. They both brought in for as respective advisors who said, well, you've got to do a $50 million JV, just put in $25 million US of cash each. In other words, they were ignoring all the other elements in the transaction. We worked with our client to identify what the value of their intangible assets was, but also the value of the other parties. Once we did that, we identified that our client's assets were significantly valuable. In fact, so valuable, they only ended up putting in $3 million of cash, and it saved them $22 million of cash. Now, the reason they were able to say that is because that was the value of their intangible assets. Their systems, their processes, their designs, their knowledge, their know-how, their trade secrets. And each of those factors was transferred into the JV. In other words, you've got to identify these, but you also have to explain it to the other party, which you can imagine the other party in this situation was not happy about having to find another $22 million. Because we said to them, well, if you don't want the data, then we wouldn't put the data. And of course they went, no, we need the data. In other words, that was the test, and that's what the asset was worth. This next example was one where, unfortunately, the company failed, and they had gone into a completely amazing technology, but had gone down the wrong commercialization path. They came in after, as the company was being disbanded, but we identified they actually had created an intangible asset, in fact, a number of intangible assets that were incredibly valuable. We identified the right buyer for these assets, ran the process, and we ended up selling that asset for tens of millions of dollars. This was an asset that was recorded on the balance sheet at cost, literally for cents on the dollar, and was able to return 45x. In other words, $45 for every dollar invested. And again, it's because the management didn't realise that this asset was valuable to an external party. They only looked at what it was worth to them. That first mistake I made, people don't understand an asset's not just what it's worth to them, but also worth to someone else. And this is a business you may know. They've been strong in Asia, a company called Airtrunk. So I got a call from Robin Cooper about 5.5 years ago. Robin rang me and said, hey, look, I've been in the Big Four. 3 of them have told me to go get a job. I'm uninvestable. My business is worth $0. The fourth one thinks they might be able to value me at $40 million, but I need to raise $100 million. So what are you doing? And he said, I've come up with a way to run a computer data center at half the operating cost of everyone else. Now, what they immediately said to me is he had created really valuable intangible assets because he was able to generate a 50% cost advantage. So I said, well, how have you protected them? And so I went to a patent attorney there to file a patent. I said, well, Robin, the only challenge with that, if you patent this, you're going to tell Google and Amazon, all of your competitors, how to do what you do. And the problem is you're not going to be able to really realistically enforce your patent because no judge is going to give you access to Amazon's data center. He said, so I should go get a job. I said, no. We're going to run a trade secret strategy. In other words, we're not going to patent it. We're going to keep it secret. We're going to manage it as a secret. So we then valued that business at $200 million. At that point, everyone thought we were crazy. This was 5.5 years ago. He put that to Grant Samuels, JP Morgan underwrote the raise, and Robin went on to raise $400 in equity and another $750 in debt. It was the biggest pre-revenue capital raise ever done in Australasia. So what's happened to Airtrunk since? So 3 years ago, Robin sold 78% of Airtrunk to Macquarie for $3 billion. And 5 weeks ago, it was announced that Airtrunk is now looking to IPO for $10 billion. This is probably the best example I can give you of not only identifying what the assets are, making sure the strategy to protect those assets is appropriate to the asset, and then third of all, not just coming up with a number, but being able to explain it to the investors. And this most investors in Airtrunk were high net worth family offices. In other words, it was the narrative explaining it. So what you find is the traditional approach to valuation looks at the fixed assets and the cash, of course, which is what drives cash flow, and that's like riding a 1980s bike. You've just got to pedal faster. That's your classic 4 times EBITDA. If you want to break away from that, you've got to identify, of course, strategic value. But what you're really talking about is intangible assets. That is where the strategic assets come from. But unfortunately, it's also the greatest source for risk. In other words, the easiest way to put a valuation down is through the intangible assets, which I'll talk about shortly. So the way we approach valuation is quite different. Of course, we still look at the quantitative, we're still looking at the potential and future cash flows. But more importantly is that what underpins those cash flows is the quality of the intangible assets. An example I often give, we often see accountants doing patent valuations. But if I can invalidate the patent, that patent's worth $0. And with all due respect, we don't know any patent attorneys that can actually look at the commercial value of a patent. So the people that we have inside Average are not just accountants, lawyers, patent attorneys, commercial people, finance people. You need a very eclectic culture to be able to look at these from multiple angles. And in particular, if you want to have your valuation not just stand up, but ultimately have an investor come into. The third element that we see is critical is the contextual. In other words, who is this asset worth something to? But then it's the ability to triangulate all three and explain it to an investor or at a capital event, IPO, etc. So
critical element. You need all three. Otherwise, if it's like three legs on a stool. If one leg isn't as strong as the other two, the valuation will fall over. To that earlier point, we come up against audit a lot and have to work with the auditors to explain why the assets are worth this. Just to finish up on risk. So the counter to value is risk. If you can push risk down, it actually will drive your valuation up. And of course, if 9% of the value is in the intangibles, what you find is people only look at what's above the waterline. And that's why we often find investors say, can I see your balance sheet, your P&L, your fixed asset register? But as we know, the real value is sitting in the intangible assets below the waterline. But that's also where the risk is as well. The 5 biggest risks we find in every single company we've ever worked with. Number one, they don't leak a little bit, they leak like a fire hydrant in bed. Is they have pain of title issues. In other words, they can't own their assets. I'll also talk about this briefly. The third area I won't touch on is that 80% of all code now is in open source. Now, open source is great, but it has some specific risks around it. Fourth is that most companies that are out there, unfortunately, don't own their brand in the way they think they do. I'll talk about this shortly. And then 5 is that if you go anywhere near, in particular the United States, it's not a matter of if you'll be sued. So risk number 1. Companies leak predominantly through either telling their customers things that they shouldn't, or tell your competitors. The same with suppliers telling competitors, and third, through employees leaving and either creating a competitor or joining a competitor. And so what you find is that it's like slowly over time you lose margin and your market share because you're leaking this information in which you're not maintaining it within your own business. And an example of this was a company called Navman who invented the in-car GPS, literally invented it. They were growing so fast they couldn't hire enough software engineers. So they ended up finding a bunch of German software coders. The Germans delivered the code on time and budget. All the management were aware of is that the engineering team had delivered. They went to do the next generation of software and the engineering team couldn't find the Germans. The Germans did eventually come up 6 months later with 25 million euro in venture capital as TomTom. Navman founded their biggest competitor, and at the time, which was 15 years ago, it cost them about $150 million. So again, well-intended consequences, unfortunately, didn't understand the risks around the intangibles. 80% of the companies we deal with don't own their assets. In other words, they don't have what we call a cloud chain of title from creation to current position. There's normally a break, and we've seen this with Facebook and Twitter and many other famous examples. And because they're not tracked to the tangibles, in other words, this computer I'm talking to you sits on a fixed asset register, yet the data inside this computer isn't recorded anywhere. And so what you find is that as you're creating these with external parties, contractors, etc., there's no tracking of them going on. And this was an example right on the investor side this time. Our investor was looking at putting money into this raise, Series C. So this was a well-established company. They were raising on $120 million pre-money. And one of the things we asked the company is to prove they own their assets. Very standard requests. And unfortunately, this was your classic startup. They were just growing fast. They had tracked a lot of these things. We ended up scaling more in disputes with former employees and external contractors. When we explained it to our investor, he decided to not invest. Other investors also followed suit, and unfortunately, that company fell over. So, on a small raise of $46 million for this business, which they didn't think would be an issue, unfortunately, ended up closing the business. The last risk I talked about, I mentioned that half the companies we deal with don't own their brand. I think it's closer to 70%. And that's because there are 2 kinds of trademark. There's what's called a device mark, the visual representation, like the average logo you see. That's a visual representation. And the word Everedge. They are 2 very different trademarks. And trademarks are registered within each country. And we saw an example of this in Apple. Apple didn't register iPad in China, and it cost them $12 million. So this was an example of an ASX company. In the very first meeting, the first 5 minutes, the CEO is telling me how they're spending $1.5 million a month every month, have done for 18 months. Plan was to grow, become the dominant player in Australia, then launch into the US. Great. One of my team was doing due diligence as he was saying this. Went across and said they don't own their trademark. Are you sure? Yes, I'm sure. We then explained to the client they'd only registered their logo in Australia, in other words, how it looked. And the easiest way around that, I changed the colour, the font, the appearance of it. And unfortunately, their US competitor had already registered their word mark, the name of their company, and also their own logo. In other words, that company couldn't operate in the US, they would get sued. So we then worked with the client, they ended up rebranding, but essentially they spent $36 million on a brand that they could never own. This was not a good example, unfortunately, as you can see. This happens a lot. And I would say it's probably close to 70%. So if you think about it, if we've got, let's say, 100 people on this call, 70% of you currently have this issue. So what do you do from here? Well, unfortunately, just ignoring this, it's not going to go away, because at some point we'll either be on the investor side or we're doing a valuation potentially for you. We will uncover these issues. But the good news is these issues are often easily fixed, and prevention is much cheaper than cure. What would I do? If I was running any of your business, first thing I'd do is identify what the intangible assets are. I'd start to treat them as assets. Just record it. Treat them the same way you do the desk, the chair, the computer. Second of all is work out what the risks are around those assets. And again, the intangible assets have very different risk profiles to tangibles. Third is work out, well, okay, we've got this asset, but who else could this be valuable to? In other words, how do we monetize these assets? And you might be splitting a piece of plant equipment machinery, then you're treating this, tangible assets the same way. And then last but not least is just having this sit within the management team. It's not good enough. That example I gave before of NavMan, that was the engineering team because they didn't see it as an asset. So you've got to educate your teams on why these are valuable. And unfortunately, the really bad news is as either a director or you'll certainly be an officer of the company as CFO, you have a fiduciary responsibility under the Companies Acts to not only try and make money from these assets, but primarily to protect these assets. Now, if you don't know where 90% of your assets are, in other words, you haven't documented your intangibles, you don't know what the risks are, I would say that you're probably in breach of that duty. So I think it's fair to say that where we're seeing intangible assets going, it's not going backwards. Countries throughout Asia are focusing more and more on intangible assets. We've seen a major shift from China over the last 6 years to go away from being a manufacturing economy to an innovation economy. In other words, they're going from tangible to intangible. And so the accounts and the accounting standards will also don't see changing very quickly. So in other words, this trend is not going to go backwards. In fact, if anything, it's going to get significantly worse. So I hope that was worthwhile. That's the end of my presentation. I'm really, it's generated some great questions for you, and I'm looking forward to answering them with Ivan in the Q&A. I will stop there and stop there. I hope that was of interest.
Okay, thank you, Michael. I really like specifically the slides where there is the comparison between the company A and B. I think it's common mistakes that people or most professionals, accountant professionals would think that the company A might be in a better shape. So in your opinion, how do these intangible assets help drive competitive edge, you think?
Well, competitive can only come from intangible assets. If you think about it, Tony, Ivan and I can both, let's say Ivan's got a manufacturing business that makes shoes. I can go and replicate that same machinery. I can probably buy even a version of the machinery, but let's say it's all the same. The only thing that differentiates two shoe manufacturers is the ability that I can produce those shoes cheaper because I know how to run my machinery. In other words, I've got better systems and processes, or I'm able to buy them cheaper, or I'm able to sell them for a higher margin because they're either better quality, or I can use things like brand, etc. In other words, it's the intangibles that are giving you that competitive edge or secret sauce. In a way, it doesn't matter what you call it, but it actually does matter what you call it. And one of the things we say to clients, we do a lot of education around the words they use. For example, if you said, Michael, I have a whole bunch of intangible assets, that actually doesn't mean anything to me. It's like saying I have IP, it doesn't mean anything. So if you want to use these things to drive value, you have to be able to explain the assets and defend the assets. So the number is not the critically important piece about intangible assets. It is ultimately, but the ability to explain the value to an external party, including your auditor, as we heard about at the very start of the presentation, you do a lot around independent testing, pushing back against the auditors, because in fairness, the auditors want to impair the assets, especially data. So you've got to be able to push back on that impairment and explain to the auditor why the assets at least the same value.
Okay, thank you. I think next, some sort of like a little summary. The business acquisitions along with purchase price allocation and IPO are among common reasons for financial accounting purposes to conduct an intangible asset valuation. And also, like Michael mentioned earlier, the corporate officers and directors are responsible for protecting the company assets, maximizing the company financial performance, and complying with laws and regulations. Hence, next more will be illustrated in our case study. Please welcome Mr. Ivan Kanel, who will be speaking to us on the case study of business valuation with GoTo as the subject company. Please, for Mr. Ivan Kanel, the time and space is yours. Thank you.
Yeah. Thank you, Ms. Ani. Okay, for today's webinar, I will present the illustrative sample for the valuation of PT GoTo, Gojek Tokopedia Tbk. I hope that this explanation will give some insight to the audience today that join with our webinars. Okay. Next. Okay. So for today we will discuss about the intangible asset valuation of PT GoTo, Gojek Tokopedia Tbk. And in this webinar, the first step we will look for the valuation process and methodology recap, and later we will look at the illustrative example for PT GoTo Gojek Tokopedia Tbk, the most largest unicorn in Indonesia, and the last one will be we will check about the reasonability check for this valuation. Okay, next. Okay, so for valuation process, there were some steps for project planning for the purpose, scoping, and identification, and for the valuation purpose will be for diligence, analysis, reasonableness, and value conclusions. Okay, next. For the methodology recap, so I will just refresh for the how we use this valuation. Will be some flash information only. So for royalty, we will use this to determine value by reference of the hypothetical royalty payments. But this future value we will calculate with this formulation. Frequent application-nya we use brand, technology, and know-how-nya. Okay. Next. We can also use excess earnings for the present value of earning attributable of the subject intangible asset. We can determine the future value for the valuation purpose, and usually we use this for the company with technology, and we can determine how much the value of the company. We can make the valuation calculation but we need some data here for revenue forecast, applicable expenses, and future tax rates. Okay, next. Okay, next slide. Okay, to determine the fair value of assets, we also can use go back to the costing. Okay, for this, okay, can we go back to the cost slide? Okay, so to determine the fair value of asset, we can use its replacement cost. So we could input all costs necessary to construct the similar assets or equivalent utility price here. Frequently used for this calculation, we can use the license and improvement certification, workforce. So all hypothetical costs that are needed to recreate the asset, including material and labor. Adjustment factor to reduce the replacement cost, like functional, economic, and technology condition of the subject of asset. We also include the opportunity cost and include the tax or tax shield. So the cost approach, we can use this to get more information about the third-party purchaser who would pay more on asset than its replacement cost. Okay, next. We can estimate the fair value of asset by comparing the value of the business inclusive of the asset. So we could calculate the future value of the valuation of the company by using the free cash flow forecast. Also, we need the discount rate, expected life of business, the revenue, the expenses, capital expenditure, working capital, and also the tax. So we can get more insight the hypothetical value of the business. Usually, we also need the information. So we need non-competition agreement, franchise, process, and technology. And then we can calculate how much the value of the company in future value. Okay, next. For the greenfield method, we could estimate the value of the asset based on the discounted cash flow. Usually for startup business with no asset but the subject of intangible. So we need here startup cash flow forecast, expected ramp-up period and pattern, the startup type discount rate, tax amortization benefit. We can use this formulation to determine the future value of the company. Usually for startup level, we also need the income and capital cost. The assumption around competition and market share, also the incremental risk premium in this contract to reflect startup nature of cash flow. Okay, next. This method is Now, many technology startup company use it. The most method that more understandable and more logical for the technology startup, like to determine the like Goto, Gojek, Tokopedia. We use the enterprise value to revenue. So in this method, we will measure the value of the stock of the and compare the company enterprise value to its revenue. So in enterprise value to revenue is one of the several fundamental indicators that investors usually use to determine whether the stock is priced fairly. Yeah? So enterprise value to revenue is also often used to determine a company's valuation in case of potential acquisition. To understand this, this method also can help compare a company revenue to its enterprise value. Yeah. The lower, the better. Generally used as a valuation. The acquirer will use this method to determine the appropriate fair value for the company. So the enterprise value is used because it has debts and take out cash. Okay, next. We can look how to calculate this enterprise value to revenue. Usually, the enterprise value to revenue is easily calculated by taking the enterprise value of the company and dividing it by the company revenue. So we can use this method, the enterprise value. We can use market capitalization plus debt and deduct the cash and cash equivalent. So the enterprise value can be calculated using a slightly more complicated formula that includes a few more variables. Many analysts prefer this method to more simplified version. So we can also use the enterprise value by this formula, market capitalization plus debt and plus preferred share capital plus minority interest and deduct the cash and cash equivalent to determine the enterprise value. Usually this method used by many startup company, technology startup company. We will look more detail about this method in this illustrative example by PT Goto, Gojek, Tokopedia. Okay, next. We also need to determine whether the discount rate need to consider for determine the enterprise value. Whether we will use the weighted average cost of capital, we need to consider the equity and the debt. Also for the goodwill, intangible asset, fixed asset, and working capital, the risk and the reward, the discount rate from the lowest until the highest. So we need to consider about the weighted average cost of capital, cost of equity, return on other assets. We also need to consider the cost of equity, the rates, the goodwill, the lease rates, mortgage rates, also asset-backed lending rates, and short-term borrowing rate. Okay, next. Okay, we will go to the illustrative example for PT Goto, Gojek, Tokopedia, Tbk. I will give brief introduction to get more understanding for the PT Goto, Gojek, Tokopedia as Indonesian largest unicorn startup for technology company, tech company. So the PT Goto, Gojek, Tokopedia Tbk is a merger from Gojek and Tokopedia, the combination of Gojek and Tokopedia. Gojek commenced operation since 2010, while the Tokopedia starts earlier from 2009. So the formation of the Goto Group here combines e-commerce, on-demand, financial and payment services, and creating the first platform in Southeast Asia to deliver the three essential services in one ecosystem. So if we look more detail, the Goto Group ecosystem represents 2% of Indonesian total gross domestic product. They have intention to continue to grow to serve all of the Indonesian consumers. Also, we'll go to the Southeast Asia, not only in Indonesia. So the Goto Group will open more and more income opportunities, especially for the driver partners here and the small entrepreneurs. So the combination of Gojek and Tokopedia here is the largest business combination ever in Indonesia, as well as the largest combination of the media services company in Asia today. The deal is backed by a range of key investors. Many giant technology companies also support Goto here. Also Alibaba, Astra International, BlackRock, Capital Group, DST, Facebook, Google, JD.com, Northstar, Pacific Century, PayPal, Providence, Sequila, SoftBank. Also Telkomsel, Temasek, Tencent, Visa join with to support the Goto. So where is the revenue for Gojek and Tokopedia? Gojek generates most of its revenue from GoPay transaction. Here is e-wallet and GoFood. For transportation online, the Gojek contribute to about around a quarter from total revenue at Gojek. How about Tokopedia? Tokopedia generates most of its revenue from top ads, advertising from the merchant to become the top from search result if the consumer want to buy something, and from power merchant status. This power merchant have an exclusive feature to increase the sales. So, however, the merchant that including power merchant category also will need to pay 1% from the product that can be sold. Okay, next. Okay, so we need to look more detail about the Goto when they go to initial public offering. So in April 11, 2022, Goto released 40 billion shares at selling price of 338 per shares and managed to obtain the fund of 13.7 trillion rupiah. So the Goto market capitalization value even reached 400 trillion and is in the top 4 public company with the largest market cap in Indonesia. If we look more detail, the equity price 143 trillion with net debt 7.9 trillion. However, the enterprise value exceeds more than 464 trillion, while the tangible asset only consists of 151 trillion. So the intangible asset here exceeds more than 300 trillion. So the identified intangible asset for this Goto, Gojek, Tokopedia, we can look for their trade name, on-demand technology, customer relationship, advertising, power merchant, e-wallet, GoPay, and the goodwill of this company. So we will look which proper valuation methodology to determine the valuation of this PT Goto Gojek Tokopedia Tbk. Okay, next. So we will go back to get more understanding about the Gojek. So, starting from 2015, Gojek received series of funding from Sequela Capital India. And then for Series B, also get funding from KKR, Warburg, Ferrara, and Capital Group. So at that time, the Gojek valuation already exceed 1.3 billion US dollar and already have the unicorn status. In 2017, Gojek opened the Series C funding. Also, Tencent joined with this investor, and the funding round closed estimate investment value of 1.2 billion. As a result, Gojek valuation already reached 2.5 billion. At the Series B funding at 2018, Gojek also get 1.5 billion from Astra, BlackRock, Libri, Google, GD.com, KKR, Enco, Meituan, Samsung, Temasek, Tencent, also Warburg. So the Gojek valuation already increased to 5 billion. In the same year, Gojek again get the Series E funding. The Alliance also joined for the investment value of the 35 million US dollar, and then the latest Series F funding around 2019 with the acquisition value of 1 billion US dollar. And lastly, the Gojek helped the Series F2 funding round with Telkomsel as the investor to get the valuation of the company reach 10 billion US dollar before they go to the initial public offering. Okay, next. For the Tokopedia financing, started from 2010, but get more recognition in 2011 when Ace Ventures joined invest in Tokopedia. Also, the company of Cyber Agent Ventures invest around 700,000 and get 10.2 billion in Series B funding. This investment make the cyber agent get 10% of Tokopedia shares. In the third year, also in 2012, Tokopedia already get more recognition from the investment company. They get from Japan and Bino Partner, Netflix Ltd. Also in 2013, the investment also come again from the SoftBank together with Cyber Agent Ventures and Ace Ventures to conduct the Series A funding for Tokopedia. Okay, next. In 2014, Tokopedia is getting bigger when they get more recognition from SoftBank and Sequela, and the investment reached 100 million US dollars or around 1.4 trillion. So Tokopedia already finally achieved the unicorn status in 2014 with the startup valuation reached 1 billion US dollar. In 2016, Tokopedia also get another Series A funding around 2.5 billion. And 2017, Alibaba joined with the series funding around 1.1 billion or around 16 trillion. So this investment strengthened the Tokopedia business not only in Indonesia, also Tokopedia expand to the Southeast Asia region. So finally in 2018, Tokopedia get another injection from SoftBank and Alibaba Group, and several participation from Sovereign Ventures Korea and another investor. So this injection make the Tokopedia valuation rise to 7 billion. Okay, next. If we go to the historical operating result, the combined business from Gojek and Tokopedia, we can look the total liabilities and equity. They reach 155 trillion. However, if we look about the valuation of the company, the valuation is much more higher. So the intangible assets for this PT Goto Gojek Tokopedia get more higher, around more than 300 trillion rupiah compared to the total asset from PT Goto Gojek Tokopedia Tbk. Okay, next. Okay, so we can look for the intelligent information, the intangible asset related to the trade names, content, workforce, license, customer, and technology. Okay, next. Okay, we will go to the total valuation here. So Goto already set the IPO price at 338 per share from the initial range between 316 and 346 per share. Based on the data we get from the IDX announcement, Goto released 40.6 billion shares to the public. As a result, Goto succeeded to obtain the fresh fund of 13.72 trillion rupiah. The target lower compared to the tech company competitors like Bukalapak, which is able to earn 25.9 trillion. However, if we look the valuation of the PT Bukalapak stock price at the IPO was much higher than of Goto. The book value of the book of Bukalapak here 38 times, assuming the equity at the time 1.7 trillion. Meanwhile, the Goto price to book value is 2.89 times until 3.17 times. The figure was obtained by calculating the total equity here, 130 trillion, and the number of shares, 1.19 trillion shares. While compared to the PBV, price to book value of C Limited and Grab Holdings, the Goto direct competitors here, PBV is still better. C Limited price book value was 8.29, while Grab recording negative equity, so PBV was impacted. If we look more detail, another indicator that often used to assess the valuation of tech company like Goto, Bukalapak, or Grab. Usually, we use the enterprise value compared to revenue. It's easier to calculate, to compare the value of capitalization and market capitalization with income. So if we look more detail about the Goto market capitalization, to revenue is 144 times and much more larger than Grab and CLTV with 32 times and 7 times. So Goto is much more larger compared with the market capitalization. However, we should note that we use the July 2021 figures, while Grab and C using December 2020 and 21 figures. However, we can look at the market capitalization ratio to revenue. It's certainly smaller in line with the trend of increasing Goto revenue in the futures. So Goto much more attractive, can get more attractive. more investor that willing to invest to GoTo compared to other competitors. Okay, next. So if we look to the technical analysis of the GoTo, many recommended that the GoTo have favorable analysis, and most of the technical indicator give green or favorable suggestion that this share, GoTo shares is very attractive. So if we can look, most of the analytical give suggestion that the GoTo shares valuation is very good to invest. However, we still need to look about the financial performance of PT GoTo Gojek Tokopedia since the latest figures from IDX, we get information that GoTo still suffer heavy loss. It's the common nature of the tech company. Okay, next. So if we check to PT GoTo Gojek Tokopedia for the reasonability check for the trade names, followed by customer relationship and the technology, GoTo already accept the expectation and pass all the requirements. Also for goodwill rate of return, above intangible rate of return, the technology at least must twice as valuable as its original cost, and the required rate of returns of all assets. And the risk profile, also the goodwill. Who will pay? Who will dare to invest with this shares? But we already checked that the GoTo share price now is not too bad for the performance and the valuation. The investors still looking for their shares compared to the other competitors. While Bukalapak suffer for the company valuation performance, but GoTo still have much more opportunity in the futures. Okay, thank you. This is the from my presentation for today webinars. Okay, I will give back to the
Thank you.
moderator.
Thank you, Ivan. That's a very interesting explanatory for the case study. I think actually maybe this is also a question that could be, think by a lot of the finance professionals or accountants. Most intangible assets aren't listed at a balance sheet. So, or if they are listed, it's often not at true market value. In your opinion, how can companies report their intangible assets to more accurately reflect their true value? Before we go to the Q&A, Ivan, this could also sum up your presentation today. Yeah, thank you.
Okay, so if we look for the intangible asset for the GoTo, we can look at the market capitalization of this GoTo is very high compared to another tech company in Indonesia, the direct competitors. If we compare to the Bukalapak or Grab, so this market capitalization and also if we look the method of if we look for this valuation of the GoTo, if we use the enterprise value compared to the revenue, this kind of industry for the technology company in Indonesia, usually they tend still to suffer loss, but they have opportunity in the future to expand their market capitalization and get more line of business and get more line of customer and more services to the customer. So for the brand name, also for the technology and the customer potential customer that is value of the company will be go higher compared to their analytical tech. So we can look also for the analytical technical. If compared to the real value of the assets, the intangible assets for this PT Goto project Tokopedia is very high compared to the real value of the asset.
Okay, Ivan, thank you. Ivan, thank you very much for addressing a case study on this interesting topic. Next, dear participant, I will share you the second keyword. I know the first keyword has been shared by Ms. Asri earlier, so now it's my turn to share you the second keyword is interpretation. That is interpretation. Yeah, you can see it on the screen now. The second keyword is interpretation. Okay. Next, moving along to our Q&A session. Yeah. Okay. So let me try to grasp some of the questions that might be asked by the audience. Yeah. Mungkin Tim, would you mind to load up the question so I could see it on my screen, maybe in Zoom, yeah. But before that, I think, while waiting for some technical matters, I think I'd like to ask question again to Mr. Michael, yeah. As advisors or finance professional, how can we help our clients or the companies we work for to leverage the intangible assets to drive value? Michael, yeah, maybe this would be also kind of intertwined with what Pak Ivan also has shared earlier. Yeah, thank you.
No, thanks, Hani. And look, the first thing I would do, in fact, we do with every single client, whether it's be a valuation or they're looking for, because if you think about it, a valuation is only ever accurate at a moment in time. You know, as Ivan just took us through, you know, Gojek was not worth that amount of money 5 years ago or 7 years ago. And it certainly won't be worth that amount of money in probably 2 or 3 years. And it would be interesting to see, you know, how that valuation has been impacted, with Grab entering the market as well. So, I mean, all these factors come into it. But the very first thing everyone on this call should do is either, if you're an internal finance accounting function, is work with your business to identify what are the things that are driving that margin and/or that market share. Once you've worked out what those assets are, then again, mitigate the risk. If you can bring those risks down, that will also increase the value. So these are the very first two things that I would do. And quite literally, I'm hoping that the people on this call just start with working out what your top 3 intangible assets are. And if you think about it, Hani, you know, ACCA is completely intangible as an organisation. You know, no one is ever going to value you on your desks, your chairs, your computers. Your balance sheet, I imagine, is almost non-existent. So if you think about ACCA, what would I do if I was you? Well, obviously, and Ivan talked about this with Gojek, you know, brand always starts off as being your least valuable asset. So the day that Gojek started, it was worth zero as a brand because it didn't mean anything. But now it's one of the most valuable brands in Asia. Yet Gojek is probably not worth that much in the US because it's an unknown brand. Uber is incredibly valuable. Lyft is incredibly valuable in the US. So once you've worked out what those assets are, then you want to mitigate those risks. They are the two easiest things that you could do. Whether it's ACCA or even Ivan's business is completely intangible as well.
Okay, that makes sense. And especially now with the world the way it is, a lot of companies, including ACCA itself, has fully transformed into digital base. I think the brick and mortar office is not just that. I think also with now there is the companies has been kind of minimize their labor. So used to be, I think, one of the biggest assets or value is our people, but now I think there is a shift in that as well. So I think to be really kind of emphasize the strengths in terms of the company's brand towards technology, and then blend it with the other resources, including the people. I think finding the fine tune of it also could be one of the strength and to differentiate companies, compared to other competitors out there. Okay, I think Mbak Astri, do we have questions here? I think if not, then I'll move along with some of questions that I can probe in as well. So
Honey, sorry, we have some trouble. So for a question, I already sent the link to your WhatsApp. Can you open the link, Bu Hani?
Oh, okay. Well,
or maybe in the chat room. I will share your.
Yeah,
Okay.
can you
Okay. Please wait, Bu Hani, for 1 minute. Okay.
Sure. Yeah. No worries. I'm actually also, before that, I'm very much interested to hear from Pak Ivan, since Pak Ivan also, have highly exposure in KAP, as a consultant himself. So,
data information from the company that we want to look for the proper valuation, because now the data is very, very critical, and we also know that the company have brand value, also have intangible assets, but we need more accurate tools to determine how to value the intangible assets of the company. So the investors that want to get involved with this company can have more understanding about the risk that they will to put to this tech company, because the tech company, like startup, now we know that many startup company also have many challenging conditions. Then we also hear that the economic condition is not good. So within this challenging situation, how is the true value of the company valuation? What is the proper valuation method that we need to put to value this company valuation? However, I think several technology companies still have better future for like photo. They have many line of new business. So I think for some of the tech company, they still have bright futures, but still need challenging data to get more accurate uh, forecasting, budgeting, and how much that the investor willing to invest to this kind of technology company in the future, because the nature is still burning money. We know that no uh, no one of the tech company can get positive result. All of their financial statement is still suffer great loss. So how that the tech company can get survive for this condition? Because the loss condition, if this tech company cannot get more investment, so they will run out of the money, and how they will survive of that business. So that kind of information we still need to analyze. This is very challenging, but very interesting to get more understanding of this variation of the tech company.
Yeah,
Okay, thank you, Ms. Anna.
Yeah, thank you, Ivan. It sort of also remind me of Mr. Michael presentations that it's intertwined between the qualitative and quantitative data, right? So while Pak Ivan said that, it seems like more available kind of resources is in the qualitative, but still needs the quantitative aspects to it as well, right, Michael? Do you want to chime in on that?
Yeah, I mean, one drives the other, and it really is like a three-legged stool. If one of the legs falls off, the stool falls over, and this is a common mistake we often see in valuations done, in particular coming out of the accounting profession, because they're assuming that, I mean, cash is cash is cash is cash. Cash is the same asset, yet intangible assets are all very, 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 very different. And so a patent is completely opposite to a brand in many regards, for example. In other words, they have different risks. The risks that apply to a brand don't always apply to a patent and vice versa. So in other words, if you don't understand the qualitative nature of that asset, but also that market contextual, in other words, finding the right buyer or investor, then your valuation is going to fall over. And this is one of the challenges we've had, is because normal side, and this is where we do a lot of education, in particular with the accountant, who's normally on the other side. And normally I'm just trying to think whether we've never had our valuation accepted. I would really struggle to think. And where they normally are not encapsulating this comes down to not so much the quantitative. I mean, accountants are great at the quantitative. It's the qualitative aspect and the contextual. And the example I use here is, it's the same reason why we don't have accountants valuing jewelry or property or cars or horses. They are very bespoke assets. And that's why, as we were talking about just before we started the call, that's where accountants will go to specialists to get those assets valued. And the one thing I can say is going to a patent attorney to value a patent is also not the answer, especially if that patent attorney is the same one who filed that patent. In other words, they're looking at it from a legal perspective, not a commercial perspective. And so this is really not the traditional mechanistic approach to valuation. It really is more art than it is science. And a lot of it comes down to really that due diligence piece in finding the right investor. For example, if we use Gojek, I suspect Hani and Ivan, we probably, if we were putting our money into Gojek, we wouldn't have valued it the same way Sequoia did, for example, because Sequoia, had much more money to be able to put in, and it was worth more to Sequoia as an investor than it was to us as individual retail investors. So that context is really, really critical. So the very first question we always ask a client when we're doing evaluation is, why are you doing evaluation. Because if you're doing it for the investor, you're often looking at the if you're raising it, doing it on everything going well. In other words, you're at the upper range rather than the lower range of the valuation.
Okay, thank you so much. That gives us a lot more a full spectrum of the questions itself and the answer, of course. Now, the next question. Actually, this would be more kind of a better if I direct this to Pak Ivan. This is from the audience. So, Pak Ivan, the question is how to calculate the valuation of a company if it has negative equity, Pak Ivan. Thank you.
Okay, so for the negative equity company, I believe they are still have lost profit and loss performance. So we need to determine what sectors that this company are running. If still in the startup technology company, I think so the information that maybe we can use to get the valuation of the company, we will go back to the market capitalization of this company, also with the brand name. Also, we can use the information of the forecasting and budgeting for the future. Because for the negative equity company, usually they are not attractive for the investor. But however, with the startup technology company, they have different interests from the investor side. So I think we can use the market capitalization information because cannot use the traditional valuation method to analyze this kind of the industry company, especially for the technology startup company.
Yeah.
They still generate revenue, but the technology company will still, if the nature of the business still not change, I think they will still suffer loss and also will get the negative equity more larger and larger. Until there are no one willing to invest for this company, the valuation can be go to zero.
Okay, Pak Ivan. So I think we are almost towards the end of our sessions for this event. But I think before I close this, there is one more question I think from the audience. Although this has sort of been kind of discussed or presented before, I think. Michael, would you mind to answer this final question? It says, what clue or how to identify our a lot of aspects that you have spoken earlier, but this could summarize also the presentations that we have today. Yeah, thank you, Michael.
Yeah, look, what I would do, Hani, is those 12 buckets that I put up on the screen, data, systems, processes, knowledge, know-how, brand, start to break it down into those buckets as a first step, that very first step. The other thing that's very helpful is start to understand how each of those individual assets works together. And quite often they work holistically. In other words, they're not working in isolation of each other. They're normally working in conjunction with each other. Sometimes they're working opposite each other too. So, for example, if you're going to patent something, then that means you can't keep it as a trade secret, for example. Once you know what those main buckets are, the next step I would start to look at what we do with our clients is understand how each of those individual assets are driving the market share and the margin. Okay, it's not just about, revenue is part of it, but you really want to understand what's the thing that's giving you that leading edge. And quite often, one of the interesting exercises we do with clients is we may identify, let's say they've got a particular manufacturing process, and they go, oh, no, everyone does it that way. We're like, well, you sure? They're like, yeah, everyone does it that way. And we say, well, okay, but your margin is 50% and your competitors is 30%. So that differential in margin is your competitive edge. And if you believe it's your manufacturing process that's giving you that, then that is your intangible asset. It really does come down to, so I was at a client last week, walking through their factory, and within an hour of walking through their factory, we had worked out why their market share was 86%. They were the dominant player because of the way they managed their factory. They had the same machinery, the same tools, the same labour in terms of, they probably had just as good of people as their competitors, but it was how they deployed those assets. That's what gave them that market share advantage. One of our clients in Singapore has almost 100% market share, and their trade secret is the most well-known thing that's out there. But what they are very, very good at is they have great relationships with their customers, and their distribution and the way that they can deliver their product is much more cost-effective than all their competitors. Now, I know that, they know that, they didn't realise that that was what gave it to them. So the first thing I would do, identify what those assets are, get them into those 12 buckets, and then start to think about how they link back to your margin and your market share. If your margin or market share is comparable to competitors, you've probably got similar intangible assets. If you've got better margin or market share, then you, by its very nature, have better intangible assets. If you're lower margin and or market share, you've got worse intangible assets. And at that point, you really need to start doing M&A to acquire intangible assets so that it can lift your margin and or market share. I hope that covers the question enough.
Yes, very wonderfully. Thank you. You summed it also in a more concise ways for us to understand. Okay, so we are at the end of our event today. And as a closing remarks from me, the business reputation often measured by goodwill, trademarks, branding or brand recognition is crucial for promoting sales, building trust, and increasing customer loyalty, which means that is actually, included in these intangible assets. Business knowledge, skills, and processes are critical for creating long-term value. And I think the corporate officers, directors are also very much responsible to create this long-term value. And with that, without further ado, I think that also give us to the final point that taking the co-branding certificate of business valuation from ACCA and IAPI is one of the key points, so that you can not just to differentiate yourself as accountant, but I think this is already merely like one of the language of the new era. Especially we have heard earlier before that the traditional business valuation is no longer acceptable sometimes. So now, if you haven't had the grasp of the basic understanding of the business valuation, I think it is time to start studying and taking our co-brand certificate of business valuation. I know Pak Ivan also already did. He was like one of the first few people that is taken the co-brand certificate. And I can urge you to urge you enough to take and get started. I think next give back to our MC, Mbak Asri. Mbak Asri, back to you. Terima kasih.
Okay, thank you Ibu Hani Karunia. So Dear all participants, I thank you to Mr. Michael Masterson and Mr. Ivan Kanel for the which has been presented, and thanks also to Ibu Hani Karunia as a moderator for guiding the webinar program so that this program can be running well, Bu. Thank you very much to all participants for joining the webinar program till end, and for the further detail on CERT-PV, you can visit our website. Mohon izin saya memberikan keterangan menggunakan bahasa Indonesia. Jadi bagi Bapak dan Ibu peserta yang ingin lebih tahu atau yang ingin lebih mengetahui bagaimana sertifikat business valuation, co-branding, IAPI, dan ACCA, lalu ada modulnya ada apa saja, bagaimana LMS-nya IAPI, bagaimana sertifikatnya, mengenai biayanya dan hal lainnya, Bapak dan Ibu, you can visit our website IAPI or our link. You can see link in the screen. Please wait. Okay, you can see the link and all information you can access after webinar ends. Okay, thank you.
You're on mute, Asri.
Okay, thank you. Sorry, all. Okay, for the next, we will share about get the certificate. Okay, participants who join the webinar through YouTube are entitled to receive an A certificate with the following condition. Number 1, participants are required to attend a series of webinar until end. Second, fill out the survey after the webinar through the link. You can see the link on your screen. Number 3, enter the right combination of 3 keywords on the evaluation form at the MC delivered during the webinar. This link is only valid 2 hours after the series of webinar live end up. That is Monday, 27 June 2022 at 12 o'clock until 2 p.m. A certificate will be distributed after the event end or starting on Monday, July 15, 2022 to the registered email. And then, for participants who are IAPI members and have registered on the IAPI system, the fulfillment of the unstructured CPD from participant in this event will be updated automatically on each participant account after getting the A certificate. Meanwhile, for non-member IAPI or general, participants who have registered via Google Form, not through the IAPI system, will get an A certificate too. Okay, participant, I will share you the third keyword. The third keyword is application. You can see the screen. Third keyword is application. One more. The third keyword is application. Okay, dear all ladies and gentlemen, it's time for us to close the webinar program today. On behalf of the committee, I thank you very much for your attention. See you again next time in another program. Assalamualaikum warahmatullahi wabarakatuh.